Hello again, traders. Dwayne here from the RFX Forex Swing Trade. The New Zealand US dollar was a currency pair that we were looking at as a possible trading opportunity at the end of this week. But unfortunately, the market failed to provide us with the bullish signal that we were expecting, which would take us back towards the resistance boundary of this pennant setup that has been formed on the 4-hour time frame. Now, as you can see here, this is a setup that was formed over the last couple of days, and as you would recall, this was the trade. This bullish wave was the trade that we made to take advantage of these movements. So the market has completed the formation of this consolidation with this last bearish and aggressive bearish wave, which reflected the market reaction to the decision by the Central Bank of New Zealand to keep interest rates at 1.75%. So the market has now started to move sideways at the support boundary, and the expectation was that the market was going to head back inside of the consolidation as part of a false breakout reversal. So this was a possible trade setup where, assuming that the market would have given us a strong bullish signal above the resistance of this small pennant here, the stop loss would have been placed just inside of the boundary, the consolidation setup. Entry would have taken place at 0.6865, and our target would be set at 0.6917. So the trading target was set to capture around 52 pips, if my math is correct. Just about 35, 55, yeah, just under about there, about 52 pips, 52 pips. So this would have provided us with a strong risk to reward ratio, since our stop loss would have been is this 25, 35 pips. So this would have been a fairly good risk reward ratio and a good rate of return on this trade. But unfortunately, as you can see, the market has not provided us with this signal. It did give us a bull candle signal here, but it was not strong enough. The candle itself was strong enough, but not enough of the candle closed above this resistance boundary. So this is why this is considered to be a low probability breakout signal. So it's no surprise that the market has pulled back instead of responding to this bull candle. So we're gonna have to wait to see what takes place if the market does provide us with another signal. What could be taking place here is that the market could be pulling back to simply test this broken resistance boundary before U-turning to provide us with another breakout signal. As you will know, this is one of the many ways in which the market can start breakout from consolidation. It can start it with a direct breakout candle, which could have been this one if it had closed higher up, or it can pull back and then U-turn to test the broken boundary, and then provide us with another signal to indicate the continuation of the breakout. So if this is a candle that appears, then essentially what we will be waiting on would be the market to, well, we would want it to pull back because we would want to capture a gain of at least 50 pips. And if this is a signal, then we could use a smaller stop loss. So essentially, as you can see here, the risk reward ratio would be much higher, and our rate of return from the trade would be much greater. So this is a possibility that we could be looking out for at the start of the week. So we're gonna wait to see if the market provides us with this strong U-turn signal. If it is, then we're gonna be waiting on the market to pull back so that we can capture the minimum trading target of 50 pips for these types of movements and capture a strong rate of return with a smaller stop loss. So again, this is the theory behind this trade, is that we're taking advantage of the types of waves that lead to the formation of consolidation. And now that the consolidation has been completed, we can continue to trade within the boundaries of resistance and support until the breakout takes place either at resistance or at support.